Welcome back to another episode of What's on Your Mind. It's been a little while since our last one, but in case you guys haven't noticed, that's because we've been busy trying to deliver a new course to you guys, which we've successfully completed, and it's available to you guys on our website. But enough of that, let's get back to the show. And today I've got Edward Shek and Raj Malhorta joining me. And guys, looking forward to, as always, getting your take on markets and what's happening in your own portfolios as well. So let's get into some of that. And Ed, perhaps we'll start with you this time.
Yeah, sure. Oi, stock pickers. It feels like it's been too long. It's good to be back. I'm going to talk about a stock called Globally Online, GLBE. It's an $8.3 billion company. It's internet and direct marketing retail. So basically, this company simplifies direct-to-consumer cross-border e-commerce. So it's effectively a software publisher whose platform integrates onto a merchant's, optimizing the experience for international buyers. Because in reality, cross-border selling is actually quite tricky. So you think of a lot of big, well-known brands, they dominate or they built their brand in the local market. They know customs, tastes, logistics. They know the market inside out. When you sell overseas, when you sell into foreign markets, it's actually quite complicated. You've got to deal with local tastes, customs, as well as logistics, tariffs, tax codes, local laws. So Globally Online does all this heavy lifting. So what is the heavy lifting? Well, it's got 25 languages, 100 currencies, 150 different payment processors, 20 shipping logistic companies, and 200 destination markets. Okay, so it makes it seamless end to end. But it's a bit more than that. They've got a great network and it's building every day with every new market, every new client, and they're still expanding. But they lean heavily on artificial intelligence to use their great data sets, which are of large value to any potential merchant. So what they're really doing is helping a brand sell overseas by optimizing their storefront on a market by market basis. So instead of saying, right, we're just selling into Europe, you've now got the data and the skills to know what sells better in Scandinavia versus Southern Mediterranean. What sometimes it's just a function of better web design. A lot of the time, it's actually what products are selling well and how they're being sold. So it's a lot more than the logistics business. It's actually driving their clients' commerciality. Okay. Now, let's have a quick look at the quants. This company, and it has just reported last night, and we're going to come on to that because it's not a particularly clear-cut picture. This company is going to make 7 cents this year. What does that mean its PE is? It's massive, 700. Do we care? Completely not. This is not an earnings story yet. It's a revenue story. It's still got a hefty valuation, 34 times sales. So it ain't cheap, because there is such a big growth potential. Whenever I'm looking to buy or sell a stock, we look at the static quants, but implicitly, I'm only buying a stock where I think the quants that I see are wrong, meaning I think there's a clear pathway for those earnings to get revised up. And obviously, we want operational leverage. We want the earnings soon to start really outstripping the revenue growth. So revenue growth, 100% last year, 70% this year, 60% next year. The earnings are 7 cents this year, growing to 19 cents this year. So your earnings are going up 150%, albeit from a low number. It's far exceeding revenue. You're starting to get a P&L, a profit delivery service. Now, generally, a brand in aggregate will get 30% of website traffic from overseas markets, but it only delivers 5 to 10% of its total sales overseas. So there's a big mismatch of delivery, and this is one of the big opportunities, this huge addressable market. Now, earlier on in the year, this company did a deal with Shopify. Shopify's got 1.7 million merchants. It's got an exclusive deal, so it's got access to a huge new market. Now, I've just come off the conference call, or halfway through the conference call, the earnings conference call. Not every one of those 1.7 million merchants has got the quality, the size, the scale, or the desire to sell globally. This company says about 2%, the largest brands on Shopify, they require the high touch globally online solution. That's 34,000 potential clients. How many do they have at the moment? 522. So they're now plugged in to potentially 34,000 potential clients off a base of 500. Huge upside. Forrester Research reckons cross-border e-commerce will be $700 billion, even with this reopening 2.0 that's happening in front of our eyes, or potentially. That's 35% compound growth year on year for the next 2 years. Now, when you look at their numbers, gross merchandise values are up 86% year on year. Revenue is up 77% year. Profit, this is from last night's earnings, up 127%. So we're starting to see that leverage. Their margins this quarter last year were 30%. They were 36% in the summer. They're now 38.2. Why is their margin expanding? They're getting scale. They've invested and will continue to invest in this great global, one-stop shop international selling machine. Every client, every sale increases the value of the data they have, and this is a virtuous feeding cycle. Okay, so they've also got scale with new verticals. This company obviously started off selling, apparel, accessories, brands that you probably own or are aware of. It's now signed up its first big consumer electronics. This is also what I like, scalability. You have got a valuable network. You're selling this product. Why can't you just sell others? So you're constantly opening up new markets. Now, KPIs and catalysts. So obviously, number of merchants, customers, there's clearly a pathway to really change the basis. Could it have a couple of thousand in a couple of years? I don't see why not. Gross retention, 98%. What does that mean? Only 2 out of 100 clients actually say thank you, but no thank you. So we can assume it's best in class, it's got a great product, it's sticky. What does that mean? It has pricing power. You start off a relationship, you're adding to their business, you're adding to your own, you're now heading off down the road to hopefully a 5, 10, 20-year relationship. Your cost of acquisition when you're loss-making is high. You've put this network in place, costs money. You sign up your first client, large total cost of acquisition. Now, as you go through the years, whatever period you amortize that cost, you're now just getting revenue growth coming through. So the metrics change. The other KPI is net retention. It's 140%. What does that mean? Well, a merchant paid you $1 last year, they're paying you $1.40 this year. So you've got a sticky client base, one that's generating more and more revenue each year, a huge addressable market, and a huge potential for new customers. Now, this is where we get into the interesting stuff. The stock hasn't performed very well. So it obviously IPO'd in the 20s. It reached a high of 80 in the summer, late August. There was an IPO lockup, and that issued 12 million shares at 64. And the stock, as of the end of last week, was at 52. Okay, so when you're going to buy a stock, which has obviously had a big sell-off, you've got to understand why. Now, part of this is obviously the placing, though, albeit it's not always the case that the stock's going to perform badly and it's disappointing price action. But as we've gone through earnings, we have seen that a lot of e-commerce results have been mixed for a number of reasons. And with this sort of reopening 2.0, we have seen some sector rotation out of the pure e-commerce, the COVID winners, into phase 2 of the reopening. That's fine, I can live with that. That said, the reason why I bought this when the stock was at 52 was I just think it's a really good entry point for a business that has got huge operational leverage and a pathway. So when it comes to price targets, I think this stock could go up 50%, 70% over the next 6 months. Could it double over a year? Maybe. Is this something that I imagine that I'm going to stay in and try and stay in? Because this is an $8 billion company. Could it be a $30 billion company? I think it could be. Obviously, we don't know the timing, but that's why I took the plunge. So I bought the January 50 calls and I sold the November 65s. Stock was down at 52. It rallied back to 58. It's reported, and currently it's showing down 6.5% pre-market. So it feels it's going to head back down towards 50. We've also seen just some very strong inflation data come out. So the old 10 years on the move, and rightly so. So again, this is a bit of a headwind. But despite that, I'm so convinced that the pathway to really improving their numbers is on. Now, a few highlights from their numbers. They have raised their full year only by 5%. They have raised their Q4 by 10%. So what does that really mean? It means it's now really accelerating into the Q4. Now, they haven't touched next year's numbers, but clearly, as I alluded to before, I clearly think numbers are just going to get ratcheted higher and higher. They've come through this period with no supply chain issues for their business from their merchants. And I just think it's going to get bigger and better and more profitable. So that's the setup. What are the risks? Well, the risks are obviously a general consumer slowdown, okay? But we haven't seen that yet. Worsening supply chains, we're just starting to see a few comments that they are improving or unexpected or unlikely to get worse. Worsening COVID, but then that should probably help pure e-commerce. And of course, the bond market sell-off, which is perhaps the biggest risk because it's a high-valued growth company. But I put it up there because I think it's a really nice example of how you can work out where the operating leverage is coming through and it hits all the marks. It's delivering. It's got momentum, big total addressable market, huge new access to clients, and all the operating leverage is coming through. They are expanding heavily, but they should be. Okay, so that's it. Globally online, it's probably going to take a little bit of a punch today in the next few days, but I'm in for the January 50s.
Yeah, that sounds like a really interesting one with a lot of upside, like you said, and great that you kind of pointed out all of those risks as well in the near term, especially. Raj, should we go over to you? What have you been looking at?
Yeah, hey, great to see you guys. I feel like it's also been a long time with both of you, so great to be back. So you know, my stance in the market right now is a little cautiously bullish still. I think we have to go to it's the stock pickers market again now as the world normalizes. So one name that I looked at, and if you know in the past, I've done a lot of stuff in fintech. One name that I really like here is LC, called Lending Club. Now the company's went through a bit of a transformation. In 2020, they acquired a bank called Radius Bank, and they switched their business model to a bank holding company. Previously, they had been a pure P2P player, which is a peer-to-peer lending company, which basically matches up borrowers and lenders without actually taking any loan risk. So now I believe this hybrid lending model, it can leverage both of its strengths in the digital lending marketplace, where they have a SAS model, which I'll go through a little bit later, and as well as its superior unit economics as a bank to retain the loans. So I really believe this flexible business model will be able to handle the potential macro headwinds better as we go forward in the next couple of years. Now, the stock has had a bit of a re-rating this year, given this. It's up 300+%, but I still think it has upside in the next couple of years, tremendous upside if it can grow its loan book to 7 to 8 billion from around 2 billion where it is now. And with that, I believe it can get to 700 million plus operating income, which makes it very cheap on a valuation basis, which I'll get to in a little bit. Now, in terms of, let's look at the quarter, first of all. The stock is now at a $4.5 billion market cap, which is in a sweet spot. If you look at the numbers that they reported 75 cents a share, which was a massive beat over a 15-cent per share Whisper number. And their revenues were 246 million versus a consensus of 221 million. And on a year-over-year basis, that's up almost 230%. So that 300% upside is actually justified pretty much when you look at those metrics. They raised guidance for their Q4 to around 250 million, and their loan originations were up 14% quarter over quarter, which was also well above guidance. Now, what's even more impressive about those beats were this was after a big hike to their guidance in Q2. So they not only massively beat in Q2, they raised this guidance and then massively beat that again. So I like that momentum. I believe that that's, that's generally a company that's got things on the right track. So let's talk about a little bit more about the company itself. So the history of the company was they were a pioneer in the P2P marketplace back in 2006 when they were founded. So while most banks and the credit unions used FICO scores for these unsecured consumer loans, Lending Club was one of the first who looked at some other borrowing factors, some other data points for the marketplace to make lending decisions. So rather than just the FICO score, they would look at other things. And now companies like Upstart, who's using AI, is trying to do the same thing. But if you think about it in terms of how loans are done, if you're a 23-year-old with no credit history, you have a bad credit score, even if you look at factors like, well, I have a job in software engineering or whatever. So that way, it actually targets good potential customers even without history. So that's something that they were a pioneer in. And so they became one of the largest players in the unsecured consumer space. So in terms of the actual business model now, what it does, it originates loans through its club marketplace, about a little over $3 billion in Q3. Previously they kept none of those. Now they keep about 20% of their loans on their loan book, and they sell the rest to the institutional clients, which is the marketplace. And that's done in this digital banking platform. And I believe that's still in the early innings of a new product suite, which has a lot more potential than they're even telling the market. So in terms of how that money is made, that marketplace, which is selling and servicing loans, that basically covers all the operating expenses. And the loans that they keep, if you look at the numbers, that's pretty much all their profit. So and in terms of the loans themselves, I'm going to show you this chart right here. I think this is the most important thing in the earnings report. If you look at this chart, what they do is they target near prime borrowers and interest rates ranging from 7% to 36%. Now, if you look at those that interest rate number, a lot of people will be massively scared off by that high interest rate, given thinking that, okay, well, all of these borrowers are very high credit risk. And that's something that a rational person might look at. But if you look at this chart here, they are far lower than the whole industry and in the whole fintech industry. So high interest rates at low default is a phenomenal story. And I think that's something the market is starting to realize, but still hasn't fully realized. And if also you look at the loan provisions on their books, because it's a newer company and they weren't quite sure they want to be conservative in terms of, taking reserves. They've been very conservative on that. So I think as the market also realized that, that's another potential catalyst and metric that the market will realize and will start to like about this company. In terms of comparisons to another company, a company like Upstart, which I'm not sure if I spoke about this previously, but their marketing cost is also much lower given their experience and past success in this market. And what's interesting is if you actually compare the two, Upstart actually just reported and they actually took a bath on their earnings. But even Upstart has a market cap of about 20 billion, and Lending Club has a market cap of about, like I said, 4.5 billion. And if you actually look at revenues projected for 2022, Lending Club is actually projected to get more revenues than Upstart. And also, what I like about their business model is, like I said, given that they also have loans rather than just the selling the loans and selling the fee business to banks like Upstart's. That business itself has the potential for margin compression. Now, while that might hurt lending club a little bit. They have the loans and they have they have that high margin business, and they can move away a little bit from the lower margin business. So, and in addition to it, like the digital platform, like I said, it's using that AI technology, and I believe that that's a space that many companies can compete in. And I think right now, if you look at it right now, Lending Club has about 12 to 13% of their market share, so that has a potential to grow as well. And some other potential catalysts that I'm not even putting into my valuation metrics right here are there's two businesses they say they're trying to go down, and they're still in the early innings of, which is auto loan refinancing and expansion. Right now, they're not very high in that. They certainly have room to grow in that, and they're not really. They still have a lot, and that's where Upstart, all of their growth is being looked at. And also the buy now, pay later. Again, that one's not in any valuation metric right now, but any potential announcement to get into that is a potential catalyst to really rocket this stock even higher. So in terms of structure, I had a November position that I rolled out into January after earnings. Now, what's important to note in that is anytime you have a trade, whether it's a winning trade or a losing trade, just because if you still want to be in something, make sure that the position is what you would want to have if you had no position on. And after the earnings report, I wanted to structure a different trade. So I rolled my position out. Right now I have in a ratio, I have the Jan 45 65 call spread in a ratio. I have more 45s than 65s. But on a straight call spread basis, you can right now buy the January 45 calls and sell the January 65 calls as a spread for around $5. And if you make 5, you can make 15. So that's a 3-to-1 risk reward. And that's just on a one-up basis. Like I said, I have it in a different ratio, but I think that that's a trade that offers a good risk reward in a name that really could have, in my mind, is a little bit macro. It's not in this environment right now where things are a little wobbly, but where you're cautiously bullish. This is a structure that would offer you a pretty good risk reward.
Cool. Yeah, I like that one as well. It's nice to hear an idea on what's in your mind in the financial space, because they're a little bit few and far between actually on these episodes. So that was great, Raj. Ed, let's go back to you. Was there any other stock ideas you were looking at?
Got a little intra-sector spread on here: long Overstock, short Wayfair. Now I've had this on into earnings, and although Overstock's rallied 25%, I still think there's quite a big re-rating yet to come. So, Overstock, about a $4.5 billion company. Wayfair's about 25. As I said, they both reported. Q3 is seasonally the weakest for online furniture, and it's clearly not a particularly loved sector at the moment. What did Overstock do? Well, their sales were down 3% year over year, but they maintained their margin and they upgraded 2022 numbers. Wayfair had 20% decline in revenue, margins compressed by 2%, and they did nothing with their guidance. So during this hard period, which often comes the re-ratings, because you can really see the strength of the business model. The CEO, Jonathan Johnson, was on CNBC about a week before earnings, saying that their model is well suited, because they're not actually building the stuff themselves, shipping it from Southeast Asia and having all those problems. They have an army of sellers whose job it is to get the furniture or the product to the US, and when it's available, Overstock will sell it for you. So they have a very different business model that's well suited, and they're gaining market share. So Overstock is now the fourth. It's leapfrog Target. So the order in home furnishings is Amazon, Wayfair, Walmart, Overstock. But Wayfair's losing out to Amazon and Overstock. So its business is going into quite a rapid decline. Now, how are Wayfair going to try and remedy this? They're not going to just take it lying down. They're going to have to spend more. They're going to have to be keener on price. They're going to have to advertise more. There's going to be more margin compression. It's quite hard to turn these sort of issues around in the very short term. Now, on a valuation basis, Overstock's 1.3 times next year's sales, Wayfair's 1.7. Now, Overstock's always been quite a hated stock. It's still got like a 12% short interest. It always attracts shorts. But I see no reason now, when we've gone through the hardest year-on-year comps for a while, why Overstock should trade at a discount. It should even trade at a premium. If it comes in line, then that's 15% for Overstock up, 15% down for Wayfair. But the real kicker for Overstock is the non-furniture businesses. I've talked about these before. It owns Medici Ventures, which is blockchain, and T0, which is crypto token and NFT trading. If you look at what's in the Medici, we know that blockchain solutions are going to solve proper world problems. The question's always been, when will that monetize? When will you have a possibility of putting a proper valuation on it? Overstock own 83% of Bit Global. Bit Global is the tech that's digitalized Nigerian currency. Nigeria, 7th most populous country in the world. As a lot in developing countries, vast numbers of the population are unbanked, but they all have a mobile phone. So about 4 months ago, Nigeria said they were teaming up with Bit Global. They were going to digitalize their currency. They've done it in a matter of months. Now, they haven't disclosed how much they got paid, but we know the structure. Every player, financial institution who wants to be on the digital network has to pay Bit Global a licensing fee for the software ad infinitum. This is, when we know what it is, this is high multiple revenue, no risk year after year. They're also going to get a little tiny slice of every transaction that happens. So they've kind of almost become PayPal in this market. Now, what's the value of that? Don't know. Is it zero? Don't think so. Is there going to be more? Yes. They've also got in Medici like digital voting, land rights, all these problems that are now starting to get monetized. T0 should be giving an update on Medici. It's usually a month after Overstock earnings. So there could be some really positive catalysts. T0 itself is the only SEC regulated place where you can trade crypto tokens, non-fungible tokens. They're waiting for a CEO announcement. They're taking their time. This is a huge potential value. Now, Coinbase reported Bitcoin revenue off a cliff, stock down 10%. What's the market value of Coinbase? 66 billion. Every 2 months, there's a new crypto exchange that gets a market value of what, 5, 10, 15, $20 billion. T0 is massively undervalued, and they need to get the right person. They need an exchange guy. They need a markets guy. They need to get more assets on the platform. But this doesn't have zero value. So if you think all of this combined could be worth $4 billion, which seems pretty low considering where we are in their run, what does that do to Overstock? It's a $4 billion company. The stock doubles. So, of course, we don't know when that realization is going to come, but you can trade Overstock Wayfair on the pure furniture, but you're still getting two massive, very free options. That's it. Oh, in terms of structure, sorry, I was long December options on both going into earnings, and I've restructured the Overstock. And carrying on from what Raj said, so I was long the December 70s. Stocks rallied to like 105, or it was at the time, and I booked my profit and rolled out because now I want the next leg up, but I haven't laddered it straight up. So if you think the stock's going to rally 25% in 2 months, now it's done that. I'm now not going 2 months and another 25%. I'm going to go longer duration, and I'm expecting a potentially slower grind up before the next re-rating. So I'm now long the March 105s, and I'm short the December 125s. So I'm still in it. I've bought more time, and I'm still just long the December 250 puts in Wayfair. So I've got that part of the trade on, and that's it. Nice and simple.
Cool, nice. So that's 4 equity ideas we've kind of talked through. Raj, I don't know if you want to add to that, or whether you've got any markets or macro you were thinking about.
Yeah, so in terms of macro, like I said earlier, a lot of times I have fintech and some tech names. I like to. I have some short tech exposure here, but I don't have time to go into it today. But one thing I really do want to go into is talk a little bit about the buzzword every day, stagflation, which is a word that Wall Street guys, we like to talk about every 5 to 10 years as a risk. We haven't really seen it since the 70s. But if you look at Google searches in stagflation, they're at a high since 2008. And I looked at a survey recently of fund managers, and the expectations of stagflation was 14 percentage points higher than it's been in any time in the last year. So that's a bit of a concern for a lot of people. That high inflation, slow growth potential, which would, and I want to talk a little bit about what that would do to the market and what I see on that front. So if you look at the median returns over the last 50 years, if in periods of stagflation, the median return for the S&P is down a little over 2%, and in every other quarter, it's up 2.5%. So there's almost a 5% spread between stagflation, non-stagflation. So that is something that is on my radar, even though I'm going to explain why I don't think it's that likely yet. But here are the data points to watch for. As the CPI just reported, it was over 6%, which was the highest reading in a long time. And if you look at GDP of expected third quarter, it's at 2.7% versus 6.7% in Q2. So obviously that's not a great trend there. Now, but in terms of why I don't see it happening yet, but what I'm looking at going forward, the big factor against it right now is there is wage inflation. It's not just anecdotal anymore. There are no workers. In fact, we need to raise wages to get people to work. And if you look at the 70s, it was high double-digit unemployment. So that's number one. Number two, and I always hate when market pundits try and compare periods that are totally unrelated. Nothing about the 70s is nothing about our economy right now is anything like it was in the 1970s. So the other reason we had high inflation in the 70s was not just spiking oil prices, which we are having now, but it was because of price controls that constrained supply. And that's the opposite of what we are having right now. Right now, the supply is delayed. It's not constrained. It's all because of supply chain, because of ports being backed up. Everything has been moved forward. You can see that with some of the companies that have disappointed with their earnings. That's what they point to. Even a name like Moderna, which we all know that's how important that is today, their revenues were taken down this year. But again, it was supply constraints. I don't think that it's even something that's not like that's that hard to move versus something like a car, which is a lot more complex to move, build, and whatever. So a lot of that is just move forward. So having said that, if we're sitting here, 9 to 12 months from now, we still have this persistent high inflation and growth hasn't picked up, or the spread between those two are still where it is today, that would make me scared of stagflation. Now, right now, it's not there yet, but it is on my radar, and those are the data points that I think you should be looking at to watch for that trend and potentially take the market down.
All right. Well, gents, I think with that, we'll wrap up the episode. Fantastic contributions from you both, as always, today. And thanks for taking the time out of your busy schedules to be on the show once again. Now, if you guys watching are interested in kind of learning how to develop your own trade ideas like Raj and Ed went through in this episode, then you've got to start by investing in yourself with some education. And that is exactly where ITPM comes into its own. We've got courses available on our website, itpm.com. Several courses for you guys to choose from depending on what asset class you're interested in and so on. That is inclusive of our new flagship PTM course, which I mentioned at the beginning of the show, which has just been released, so you can find out details about all of that on our website. We'll also be able to find out about our mentoring programs, again with guys like Ed and Raj here, and our upcoming events as well. So one event that sticks out at the moment is a big one that we've got coming up at the end of the year. I think it's December 18th, which is our end of year conference. that's just going to be basically an all-day sort of trading conference where these guys that you see on What's on Your Mind will be talking about various trading topics, and it will be a really interesting one for you guys to attend and learn from. But that's it from us today. I hope you guys enjoyed the show, and make sure you join us again for another episode of What's on Your Mind.